Welcome to the Deep Dive. Today, we're digging into a really fascinating corporate document. It's the 2015 Annual Shareholder Letter from Fairfax Financial.
Yeah, it's more than just numbers. It reads like a manifesto on extreme caution, right when markets felt pretty frothy.
Exactly. And the mission for us, and for you listening, is to unpack this paradox.
It really is a paradox because in 2015, Fairfax had its best underwriting year ever. I mean, truly world-class performance in their core insurance business.
But at the same time,
Our investment portfolio had the lowest returns in their entire 30-year history. And you need to grasp this. That wasn't a mistake. It was totally intentional.
intentional defense.
Right.
And just to set the stage, let's look at that 30-year history before 2015.
It's crucial context. They started in 1985 with less than $10 million. Book value was, what, $1.52 a share?
Tiny, and by the end of 2015,
It was $403 per share. That's compounding at 20.4% a year, including dividends. Just phenomenal growth.
an incredible run, which makes the 2015 headline number even more striking.
Yeah, because in 2015 itself, book value per share only went up 4.5%, including the dividend. And that slowdown, that was the cost of being cautious.
Directly linked to the CEO's view that a potential 100-year financial storm might be brewing. Protecting capital was the priority.
Absolutely. Preservation over maximization.
Okay, let's get into segment one then. The engine room. While investments were muted, the insurance operations were, firing on all cylinders.
Oh, completely. The core business was incredibly healthy. You look at the numbers, they hit a record underwriting profit, $705 million.
And the key metric, the combined ratio.
A record low, 89.9% consolidated. Remember, anything under 100% means you're making money just from the insurance itself before investing a dime.
And 89.9% that's excellent discipline, especially across a bunch of different insurance companies.
It really is. And it wasn't just the average. Look at their standout performers. Zenith National, the workers' comp specialist, came in at 82.5%. And Odyssey, the reinsurer, 84.7%. Pretty much all their major companies were under 100%. It points to a really strong underwriting culture across the board.
And this strong underwriting performance directly fuels the main advantage for an insurer, right? The float.
Exactly. Float is the money they hold temporarily, premiums collected but not yet paid out as claims, reserves set aside. It's capital they can invest.
And in 2015, how much float did they have?
It totaled $17.1 billion. That worked out to about $769 per share, a huge amount of capital.
And the goal isn't just to get float, it's float at no cost.
Right. And they actually did better than that. Because their underwriting was so consistently profitable over the previous 10 years, that float didn't cost them anything. It actually provided a benefit of 0.8% per year.
A benefit. How does that compare?
Well, think about it. Over that same period, the Canadian government had to pay about 3.3% interest to borrow money. Fairfax was essentially getting paid 0.8% to hold $17 billion.
That's incredible. Free money plus a bonus.
Pretty much. And it's sustainable because of their decentralized structure, letting entrepreneurs run their businesses and sticking to those core guiding principles: fairness, long-term focus, honesty.
Okay, so the insurance engine is running perfectly, generating this massive, basically free pool of capital.
Yeah.
So segment two, where did the money go? And why the poor investment returns?
Yeah, this is where the caution really bites. The 5 years ending 2015 had the lowest average investment return in their history, just 3.0% per year.
And that was by design.
Absolutely. The CEO was deeply concerned about, as he put it, speculation in financial markets. He thought things were getting dangerous, so they pulled back. They actively chose not to participate fully.
How did they pull back? What were the defensive measures?
Primarily two big things: hedging against stock market declines, so shorting equities, and buying massive insurance against deflation using CPI-linked derivatives.
And these hedges, this caution, it had a real cost.
A staggering cost. From 2010 through 2015, the cumulative loss on those equity hedges and the CPI derivatives was over $3.6 billion.
Ouch. $3.6 billion is a lot of potential return to give up just for being cautious.
It is, but they saw it as an essential insurance premium. Like paying for fire insurance on your house, hoping you never need it, but glad you have it if disaster strikes.
Let's unpack those CPI derivatives a bit more. $109.4 billion notional amount. That sounds huge.
It is a huge number. The notional amount represents the scale of the underlying index they were betting on, not the actual cash outlay or risk.
Right. But why hedge against deflation? Falling prices. Most people worry about inflation.
Because severe deflation is historically catastrophic for financial systems. Think Japan in the 90s or the US in the 1930s. Asset prices collapse, debt becomes unbearable. It can cause a systemic meltdown.
Okay, so even if their insurance businesses are solid, a total financial collapse could still hurt them badly.
Precisely. These derivatives were designed to pay off massively if deflation really took hold in the US and Europe, becoming embedded, as the letter says.
So they're spending billions on this protection, money that could have been making gains in a rising stock market,
Yes.
to guard against something almost everyone else thought was impossible, especially with all the quantitative easing going on.
Exactly. It shows real non-consensus thinking. But here's a fascinating twist. In 2015, those CPI contracts actually started to increase in value slightly.
Really? So their bet was starting to look less wrong.
Maybe. It suggested that underlying inflation expectations were starting to fall just as they feared. It's like they were willing to be wrong for years, absorbing those losses just to be right when it mattered most.
Which brings us to a kind of puzzle in segment 3, growth in intrinsic value. If they were so defensive, anticipating this storm, why were they also buying things? They went on a bit of an acquisition spree.
Yeah, that seems contradictory, right? But it's key to understanding their strategy. They weren't buying risky speculative assets. They were deploying capital into what they saw as high-quality, durable operating businesses.
Especially in insurance.
Right. They bought Brit Insurance, a big player at Lloyd's of London, expanded in Eastern Europe and Vietnam. But look at Greece, they bought 80% of Eurolife.
Greece. That sounds risky in 2015.
Maybe, but look at the business quality. Its P&C operations had an average combined ratio of 60% over the previous decade. 60%.
60, that's unbelievable underwriting, almost unheard of.
It's buying operational excellence. And in India, they upped their stake in ICICI Lombard, paying 5 times book value. They explicitly said it was worth every dollar and more. That's confidence in long-term quality growth.
Okay, so buying great insurance businesses fits.
Huh.
But what about the non-insurance stuff? They created Fairfax India.
Yep, raised $1 billion in an IPO for it, investing in things like collateral management and financial services in India. Again, long-term growth focus.
And then the really surprising one, restaurants. They built a big Canadian restaurant group, Cara, the Keg. How does that fit the defensive posture?
Well, you could argue these are stable, cash-generating businesses. People still eat out, even in tougher times. It's less cyclical than, say, mining or tech.
So building a durable asset base.
Exactly. They ended up creating the 3rd largest restaurant group in Canada after Tim Hortons and McDonald's, over 1,100 locations. It's about building intrinsic value through operating assets, separate from the market speculation they feared. Even if book value growth looked slow because of the hedges, the underlying value of the company, the intrinsic value, was definitely growing.
Okay, that makes sense.
Yeah.
Deploying capital carefully into real assets, which contrasts sharply with segment 4, the bearish outlook. Let's go back to why they felt that $3.6 billion hedging cost was necessary. What were the specific risks they saw?
The CEO was really clear. He did not believe the 2008-2009 crisis was truly over. He thought it was just papered over with debt. One of the biggest red flags for him was the commodity market.
Right, you mentioned the price drops. Can you give us those numbers again? They were shocking.
Yeah, between the 2011 peak and late 2015, oil down 67%, copper down 54%, iron ore down 69%. Just a brutal collapse.
And it wasn't just prices, it was the debt tied to them.
Exactly. He pointed out that many mining companies took on huge debt to make acquisitions right at the 2011 peak. He mentioned Cliffs Natural Resources. Specifically, its stock was down 98%. That debt load became crushing when prices collapsed.
He also warned about a bubble closer to home here in Canada.
Yes, Canadian housing. He drew a direct line to the U.S. subprime crisis, said prices in Toronto and Vancouver were being fueled by lax lending, creating massive debt levels, especially for younger people. Same script, different location, basically.
And tech stocks. This was written just before the tech wobble of early 2016.
Right. He noted the sharp falls already happening. Twitter down 74% from its high, Yelp down 79%, and he coined that term unicorps for the private tech unicorns that were running out of cash and couldn't raise more, a sign that easy money was drying up.
And finally, the financial distress signals he highlighted seemed particularly worrying.
He talked about the high-yield bond market junk bonds becoming moribund, especially for energy companies hit by the oil price crash. But the real alarm bell, the failure of 3 high-yield bond funds.
He explicitly compared that to something specific, didn't he?
Yes, he compared it to the failure of the Bear Stearns hedge funds back in 2007, which was one of the early tremors before the big earthquake of 2008.
And he called this a potential Hyman Minsky moment. What does that mean exactly?
Hyman Minsky was an economist who theorized that long periods of stability and prosperity actually breed instability. People forget risk, take on too much debt, speculate, until eventually the debt structure becomes fragile. The Minsky moment is the tipping point, where confidence evaporates, asset prices fall, and everyone scrambles to sell to cover debts, causing a crash.
So the failure of those drunk bond funds was, in his view, a signal that the Minsky moment might be arriving, that the debt structure was starting to crack.
That seems to be exactly what he feared, that the stability created by cheap debt was about to break.
Okay, let's synthesize this. We have this core paradox. Fairfax, on one hand, running this incredibly efficient, profitable insurance operation, generating billions in low-cost float.
World-class operation, float coming in at a benefit of 0.8% a year.
But then channeling that strength into an extremely defensive investment posture, preparing for what the CEO saw as potentially a once-in-a-century financial storm.
And this entire strategy, this willingness to sacrifice short-term gains for long-term survival, it really depends on the governance structure.
How so?
The CEO has made it very clear, publicly, multiple times, that he won't sell the company. He stated he wouldn't accept a takeover offer irrespective of price.
Which protects them from
What?
activist investors.
Exactly. It shields them from pressure for short-term results, from short-termism, which he clearly believes is dangerous. It lets them stick to their long-term cautious view, even when it's unpopular or costly in the near term.
And his own compensation reflects that long-term view too, right?
Yeah, his salary hadn't changed since 2000 CDN, $600,000. No bonuses, no stock options. It aligns his interests with long-term capital preservation, not short-term stock performance. It makes the strategy credible.
So the success or failure really hinges on whether that storm actually hits. If markets kept booming, that $3.6 billion hedge cost looks like a huge missed opportunity.
But if the Minsky moment did arrive, if the systemic crisis unfolded, then that $3.6 billion wasn't a cost. It was the price of survival. It was the premium paid to ensure they had capital when others didn't.
Which leads us to our final provocative thought for you, the listener. How do you value patience in investing? What's the intrinsic worth of being wrong, as the letter implies they were for years, but then potentially being right when it matters most?
Yeah. How should we measure the success of that massive hedge? Was it about the returns it didn't make during the bull run? Or was its real value about protecting the company during the potential collapse that, based on all those warning signs in 2015, seemed like it could be just around the corner? It really forces you to think about short-term results versus long-term resilience.